With 10-year yields as low as they are, and especially they look like they're set to get lower if the Fed is entering an easing cycle, equities have gotten really competitive when it comes to payouts in the forms of dividends. It's really interesting when we look into the members of the S&P 500 because nearly half of them pay out more than the U.S. 10-year yield. In fact, a third of them pay out more than the 30-year, which is pretty remarkable. So this picture, these high-yielding stocks might be pretty attractive for any sort of investor who's trying to augment the income portion of their portfolio because they're not getting it from 10-year yields from U.S. government notes. But these stocks have high yields for a reason. When we look at the list of the highest yielding stocks, you'll see a lot of names like Macy's, brick and mortar retailers. You also see a lot of REITs on there like Macerich, which supply those the leases for those brick and mortar stores. So Bespoke Investment points out that sure, among these top yielders, there are definitely some companies that are going to win, that are going to do very well over the next few years. But still, there are companies that are very likely to either slash their dividends or go out of business. Now, I also want to take you into the charts to really emphasize just how risky some of these names are. Now, when we compare, I made a basket here in the white of the top 5 highest dividend names in the S&P 500. Year to date, they've slumped 16%, and you'll compare that with the S&P 500 on the top, which has gained 20%. So this really shows us that, yes, you can go to the high dividend names because U.S. 10-year yields are so low, but they're certainly a lot more risky than a government bond.